Green.
So, very warm welcome, everyone.
I hired her. Yeah, I love it.
It's great to see you all here. My name is Sarah Rupert. I'm with the Heinrich-Böll Foundation. I'm also the Debtor Relief of Green Inclusive Recovery Project, DRGR, and we are hosting this event. And it's great to see so many of you here in the room, but also online. So we are here for a discussion on tackling sovereign debt problems amid global shocks. And I think, as you all know, and we've been all attending already several events on sovereign debt this week, this is an issue that is supposed to be quite defining for this year. Debt sustainability is very prominent, featured on the agenda of the G20. We have the Jubilee year, we have the Financing for Development conference, and several debt-related expert groups and commissions that were set up, and all of them working on concrete proposals how the sovereign debt crisis of the global south can be addressed. And within this context, of course, there's also the global shocks that we are witnessing right now. So the trade disruptions really pose a heavy problem for many of those countries. It is expected that once they are implemented, many of the tariffs, that this will lead to limited fiscal space, to issues of lower growth, and also limited access to international capital. And while this is quite bad for many of the countries of the global south, it's also not limited to them, because as Kristalina Georgieva put it last week in the Economic Outlook, everyone suffers as financial conditions worsen. And with this, I think the question for this panel today would be, what do these global shocks mean for the debt reform agenda this year and the future of debt-strapped countries? And there's a lot of debate about whether you call this a sovereign debt crisis or not. I would argue it is, if you look at it from a development perspective, because it's undermining concrete development progress in many countries. But there are already many proposals underway. And I think the big question here is not whether we have the right analysis or the right data, because I think we have. The question is about how they can translate to action. And I'm very pleased that we have such a distinguished panel here, of whom many already have made suggestions how this crisis should be addressed. And this is something that we would like to discuss in this panel today. And just to give you a short overview, so we will start with short opening statements by all of our panelists. We will then dive in the second round a bit more into concrete solutions and proposals, and then have a Q&A session at the end where everyone online, but also in the room, is of course invited to participate. One of our past panelists, Yemi Osumbaju, he will arrive a few minutes later, so just want him to excuse. But I think we should start right now. And my first question would go to you, Penelope. So I think you're fairly known to everyone here in the room, but you are with the UN Trade and Development, or also known as UNCTAD, and Head of Debt and Development Finance. And of course, what we are witnessing right now with the trade disruptions and the tariffs is something that UNCTAD is premised to look at. And there was also a recent report that was called Escalating Tariffs, the Impact on Small and Vulnerable Economies. So in your view, how do you think that the current trade disruptions and potential tariffs affect low-income countries that are already facing high debt burdens?
Thank you very much. It's a pleasure to be here. Thank you for having me. So I thought I would start by just thinking about this as a kind of, in relative terms, a relative story. So if you think about the growth of a continent like Africa, of their debt stock, say since 2010. The debt stock has grown. It's grown about 2.5 times. So it grows from around 436 billion in 2010 to 1.2 trillion in 2023. But what happens at the same time is that there is this disproportionate increase in the costs that these countries have to pay to service that debt. And so over the same period, for the African continent as a whole, the costs increase 4 times. So it's almost double the rate of the increase of the stock. And so the question is, why does this happen? And of course, the big part of this happens after 2018, 2019, and then there is a lot to do with COVID, of course, the escalation of wars, invasion of Ukraine, the effect that has on imported food prices and so on. And if you're looking at external debt, you can see that, of course, exports don't recover. And of course, one of the ways in which we measure the cost of debt externally is what share of the export revenue do these repayments take up. So, and at the same time, we've also looked at, if you just look at the African continent again, and you say, if we look at the 45 countries for which we have data, external debt sustainability deteriorated between 2017 and 2023, so that 82% of Africans live in countries where both the external debt and the public sector debt have deteriorated. So you've got quite a gloomy picture. And of course, some of these least developed countries are in Africa that you speak about. We've done some recent work, and my SG was talking about it earlier this morning. There are 56 countries that have been targeted by tariffs that in fact make up around about 0.1%. They each account for 0.1% of the US trade deficit. So they really are very small impactors on the US economy, but some of them are facing up to tariffs of over 60%. And so obviously, I've been around yesterday quite a lot listening to Kristalina Georgieva, and she talks about making a crisis into an opportunity. So of course you don't know how to predict the future, but as it stands, this is a really negative impact on these countries should these tariffs exist. And of course, the issue that we have all been talking about is uncertainty. I think that it's right to say that for these countries in particular, probably this uncertainty is paralyzing them because it's so profound in some cases. If you're Madagascar, you only have vanilla bean. If you now have to pay a tariff of over 50% on that vanilla bean to your biggest market, what does that do for you? So I think there's just this notion of the uncertainty. But then the second thing is the complexity of it. We published this little article as UNCTAD, I think around about the 13th of April. And when you look at it and you look at the different measures by which the administration was able to impose those tariffs, the different clauses in law, the different variations on sectors. So it's aluminium, or it's car manufacturing, or it's something else. And then there's broad-based tariffs. Even the 10% that we are now at, I think we have to acknowledge is high. It's high for what we had before. And although there's a sense of gratefulness from the international community, because it's not 56% or 64%, in a way that is misplaced gratefulness. So that already is enough of a disruption, that 10%. So I think where we are really concerned is that many of these countries, because they're least developed countries, they have huge exposure to multilateral development bank lending, multilateral lending. They have some bilateral lending and a small share of private sector lending. But the question is, where do they go forward, especially if there's a sense in which the multilateral extension may be also chilled for various reasons. And so we see it as very negative. I think, and we can talk more about data afterwards, but I think, you know, the baseline scenario is that we are deeply concerned about the welfare of these countries and the people in them, because behind that are people who are going hungry and social programs are being stalled. Just one final thing. I know that perhaps I invoke this more often, and perhaps in this hallowed setting, it's not the right place, but I think it's worthwhile remembering the London Agreement of 1953. And the London Agreement of 1953 was a kind of a realization by the Western powers that after the disaster of the reparations imposed on Germany after World War I, that they had to be much more cautious. And so the key elements of that London Agreement was that in demanding repayment on the reparations from Germany for both world wars, they first of all forgave Germany 51% of the debt. And then they had a commitment to say, we will demand of you to repay your debt, but we will have it up to a certain threshold of your export earnings. As I understand, that export earning threshold was around 5%. It never actually reached that. But there was this understanding that 5% was a kind of a reasonable number. And then the third element was there was a commitment by the Western powers to buy Germany's exports. And so there was an export market that allowed for that. And in comparison now at the end of 2023, we see, if you look at sub-Saharan Africa, so not the entire continent, but if you look at sub-Saharan Africa, they were servicing the share of exports that they were using to service their debt was just over 20%. So that gives you a kind of a mark of where we are and where we're going forward. Thank you.
You mentioned the increasing complexity that we are facing with regard to sovereign debt, and I think one is, of course, related to the fragmented creditor universe, which differs quite substantially depending on which country you're looking at. But the other one is also the question about solvency and liquidity. In this context, I think the report by the World Bank on international debt last year was quite interesting, and the forward that you in the McGill wrote, which caused quite a stir, because you openly said that many of those countries are facing a solvency crisis, and that this will require debt relief, and that short-term fixes, as we used to do many in the past years, won't solve the problem. So I would like to hear a little bit from you why this hasn't taken up yet in a way that the report has argued for, and how do you think this could be changed?
So let me actually, I just want to flesh out some of the numbers that I agree with that. I wish I could show these slides, but so I have over here the share of emerging markets and developing economies that are at no risk of debt distress, moderate risk of debt distress, high risk, or in debt distress. Now, this ratio in 2000, the ratio of these countries in 2014 was less than 25%. That were either in debt distress or at high risk of debt distress, right? If you look at that ratio today, this is 50%. So that ratio basically has doubled. Of course, you almost had no countries that were in debt distress in 2014. today there's about a third of the countries that are either high or in debt distress, about a third of them are in debt distress, right? So that's what this ratio basically looks like over here. It's gone up like that, right? Okay. And then the next question is, all right, so why has this happened? And there's a very simple way to tell how why it has happened. One thing is that you just look at what's happened to growth. And the other thing is you look at what's happened to the cost of borrowing. Because growth is important because debt is just a claim on future output, okay? So if your future output is going to be high, robust, and so on, you can sustain the debt. Unless the cost of financing this debt and so on spikes a lot too. Well, both those things have happened at the same time. So if you look, for example, back in 2010, the long-term growth forecast for emerging markets and developing economies. So these, by the way, I'm talking about countries that are about, let me think, about 150 countries. So it's not a small amount. This is essentially 85% of the world's population, right? So if you look at them, you basically find that the growth forecast for these countries, long-term growth, has gone down a lot from more than 6% to just to actually 4%. Okay? So it's basically fallen by 50%, right? This makes a huge difference. I mean, 1 percentage point drop in long-term growth can change the arithmetic completely, right? Then, if you look at policy interest rates in advanced economies, which drive world interest rates and so on, if you look at that, you know, between 1990 and 1999, these were very high. Okay, so they were as high as 6%. Now, between 2000 and 2009, that ratio, the cost of borrowing came down by half. Okay. So at the time that the Latin Americans and all were in trouble, it was a very high interest rate. That was sliced by half by 2000, between 2000 and 2009, right? And by the way, when you look at 2010, 2019, which is the next decade, it was sliced by another 60% or so. It was down very, very low. It was almost zero at that time, right? In terms of, now, if you look at that rate, that has gone back up above what it was in 2000, between 2000 and 2009. It's inching up to 4%, okay? So it's gone from about 1% to 4%, which means that at the same time that the growth prospects of these countries were getting sliced, the cost of borrowing is now going up. So based on that, the natural thing then you sort of say is, all right, you know, if you look at the third thing that Penelope said, which was that, okay, now take a look at the poorer third of these countries, right? Which are essentially what we call IDA countries. These are about 75 countries. They have per capita income levels of less than 5,000. But sometimes it's a little bit more, but they have really volatile economies like the small states and so on. If you look at what has happened to their interest payments as a share of, let's say, government revenues, right? That has gone up during the same time, 2014, 2019, 2024, it's gone up from about 11% to about 20%. So basically, this is what we mean by the fact that these countries are under stress. Now, if you say, okay, you know, how many of them are in debt distress? It would be a smaller fraction. But if you look at this, you say, how many of them are likely to be under development stress right now? How many of them are likely to go into the ranks of debt distress if, let's say, you have a sudden slowdown in the world economy, right? So that even that potential growth rate of 4% that you're talking about won't actually be reached. And now you start to sort of see the risks of these countries going in. That's the reason why we wrote that forward, because we had these numbers. So if you look at that ratio, which is percent of the percent of net interest payments as a percent of exports of goods and services, right? To the extent that you're borrowing abroad, exports matter because that's how you're going to finance that. That has gone up from about 9% to about 15% already. Now, if you find that the world trading environment, until a few months ago, we were expecting trade to grow at around 3% this year, 3% next year. We've just revised our forecast for that. We sliced it by half, both for this year and next year. Now you start to see the strain there too. So you actually start to sort of see those are roughly the numbers. This is not subtle arithmetic. This is actually pretty crude arithmetic. And I mean, you don't need to sort of say, oh, well, will this problem only happen if this happens and so on. This is I think a recipe for an impending crisis. Now, the other thing I said at the Brookings thing was, fine, so you have this problem, but let's say you're really well prepared for it. You know exactly who owes how much to whom. The second thing is, exactly, you can distinguish between countries that are just illiquid. They just need temporary help, reprofiling and so on. And then the others who really need a debt treatment, whose debts need to be written down. And then the third thing, once you know that, you actually have a very good mechanism by which you can restructure debt. If you have all three of those things, completely transparent debt, good mechanisms for assessing sustainability, and good efficient mechanism for restructuring that debt, it's okay. But you don't have any of those things. Hope I've cheered you.
So that's a challenge we are facing. Maybe you can also provide us with the data afterwards so we can share it here in the room. Perfect, thank you. Let me now turn to you, Anaï. You lead the work on sovereign debt at IISD, International Center for Sustainable Development. And you, in the recent paper that you published, you looked at debt vulnerabilities and also reviewed existing debt relief efforts. So maybe you can provide us an insight on where we are standing on both sides.
Thank you very much, Sarah. It is a pleasure to be here. It's a pleasure to be kind of joined with such kind of stellar co-panelists. I think that I'd like to kind of pull on some of the kind of comments that were already made by the preceding speakers. I think kind of our starting point for this report was essentially kind of the debate on the one hand, are we facing a liquidity problem or are we facing a solvency problem? And then on the other hand, is this a systemic crisis? Or is this rather a kind of context of overall greater fragility with individual defaults? I think that a particular kind of trigger, we were already kind of very much into the process of doing the research for this, that was the communique of the 8 former prime ministers of sub-Saharan Africa, who said, this is the worst debt crisis we've seen in the last 80 years. And I think that statement was kind of very telling in a way, and for us, a motivation to really try to understand current debt vulnerabilities better. Because as you in this crowd all will know, these 80 years, of course, also include the pre-HIPC era. So the puzzle that we were trying to answer is, how can we make sense of this statement? How can we understand that these former prime ministers are telling us that this is worse than pre-HIPC, that this at least feels worse than pre-HIPC? And we started essentially by kind of looking at many of the kind of debt statistics that Penelope and Indermit just mentioned. We looked at stocks, and that kind of really makes the puzzle even more surprising because debt stocks, as Indermit just mentioned as well, are much lower than in the pre-HIPC era. Interest rates are high, definitely so, but they're also not as high as they were in the pre-HIPC era today. So the question for us was a little bit, what explains this? And one of the key findings of the report is that there has essentially been a change in credit composition that is no news. But I think that the most established story so far is one where kind of the focus is, of course, on kind of the rise of non-Paris Club creditors within the PPG universe. Also within that universe, the rise of particularly bonded debt, so the rise of kind of private PPG debt, particularly bonded debt. But one thing that is less mentioned and which we found is that there has also been a very large increase in private non-guaranteed debt. So kind of the countries that we were looking at were IDA eligible countries, 73 countries for which we have existing data. And what we found is that this kind of increase in essentially private sector debt in these countries was comparable to the increase of private PPG debt over the same time period. And that for us kind of really started to explain the story as to why it was that these countries were under such strains. To be kind of 100% transparent, debt stocks were similar, including total external debt, so including private and non-guaranteed debt, than they were in 1985, which is the year in which the HIPC initiative was launched. But they were not as high as, say, in kind of 10 years later. The HIPC initiative, as you all know, was a long term in the implementation making. So you might still say, okay, this explains part of the story, but it doesn't explain it all. And here I think it is crucial to understand that private non-guaranteed debt essentially has two central characteristics. It has much shorter maturities. It's much more kind of also sensitive to markets and market movements. And then secondly, it's also much more expensive. So what kind of led us, the conclusion of this for us all was that essentially countries are not only facing a public debt problem, which Penelope rightly remarked, but they're facing a kind of total external debt problem. And kind of the mechanism for us is, first and foremost, they're facing acute balance of payment pressures. And these can then translate into kind of total external debt sustainability problems. That's, I think, the first main finding, and kind of on the basis of that, we kind of very much side on the side of the debate that says this is as serious as it was pre-HIPC for different reasons, but it is as kind of straining. And debt is a systemic risk. Debt currently is a systemic risk, which doesn't mean that we are in a kind of systemic debt crisis quite yet, but it poses a systemic risk, being defined as it can affect several regions in the world. It might potentially affect financial centers. And I think that the kind of second conclusion, as I said, is we need to look beyond kind of PPG debt. We need to understand that it's a balance of payment problem that affects external debt sustainability. Just to conclude, the kind of, I think the second very important insight of our report as well is that in a way, the devil's in the details. So I kind of spoke about, like private non-guaranteed debt increasing in 73 IDA eligible countries. But if you look at it in greater detail at this aggregate level data, you actually see that the story is more complex. So you still have kind of 43 countries out of these 73 whose kind of major exposure is in official external PPG debt. So where countries have more than 90% of their debt owed to kind of official external creditors, meaning bilaterals and multilaterals. Why is this important? Because when we were thinking about designing an initiative, I think one of the main considerations is leakage. So if, say, you do something kind of analogous to HIPC, you provide kind of a substantive net present value reduction from the official sector, or say from the bilaterals, the main concern is, well, this is going to leak into the private sector. Now, what we found is that for 43 countries, this is not necessarily the case. For 43 countries, leaking is limited. Having said that, you still have 30 other countries, right? And these 30 other countries, and there is a kind of strong potential for leakage, because some of these countries have kind of a strong exposure to private PPG debt, others to kind of private non-guaranteed debt. And then you have kind of the fourth bucket, which is maybe the most complex, which essentially has it all. So just to kind of then link it to what we're going to be discussing in a minute, I think that if we're thinking about a debt initiative for the current context, we definitely need to take into account that, yes, we have a more fragmented creditor universe, but it is not only constrained to kind of the PPG world, which was much more the case in the kind of pre-HIPC era, right? Kind of in the pre-HIPC era, there were kind of very few countries that had any exposure to private non-guaranteed debt. And within the IDA eligible countries bucket, of course. And then secondly, that heterogeneity matters. So that however we design an initiative, if we want to design an initiative for IDA eligible countries specifically, we need to be able to balance on the one hand, kind of a big enough carrot to be able to incentivize countries to actually participate with complementary measures in cases where leakage happens. So I think that that's maybe the two most pertinent findings for that question.
So it was already brought up that many of these least developed countries are situated in Africa, and that there's an initiative of former African heads of states who aim to work on the topic of debt and particularly debt relief, of whom one is here. Your Excellency, Yemi Osinbajo, delighted to have you here at our panel. And what I would be interested to hear from you is a little bit the contradiction that we are facing with regard to Africa, because on the one hand, it's the epicenter of the sovereign debt crisis, but at the same time, it also is one of the fastest growing continents. There's huge potential with regard to renewable energy reserves. There are many critical minerals that are needed for the green transition. You have a very young and vibrant population. So do we need a specific African fixed solution to address the debt and also the climate crisis, of which Africa is also very much affected by? Or can we also do it with a global solution? What is your perspective?
Thank you very much. And I'm so sorry that I'm late. Was another session a few minutes ago. Let me say first, I was quite fascinated by Anahi's presentation, and I hope that we'll be able to get to see that here. Because I think one of the critical issues in designing a model that works for debt relief for Africa is being able to understand the nuance, because there is quite a bit of nuance. And I think that is a feature that we must take into account. It may not necessarily be one where we are recommending, there is a broad concept, but then there must also be, sizes, different sizes, and different ways of looking at some of the specific countries. I think that we're in some senses a perfect storm to Sarah, to the point that you made. There is a climate crisis, which obviously has its own implications. ODA is drying up and all of that. And there are so many different complications around raising finance and all that. Yeah. So I think that there are ways in which we must think in an Africa-specific way. And that is because some of the challenges are Africa-specific. Africa is warming faster than any other part of the world. There are tremendous, obviously, renewable energy resources and all that. There is a move for making Africa the first truly green civilization, because obviously we're starting from a different level in terms of industrial base, far less legacy assets to worry about and all that. So there is a real opportunity to have to develop, renewable energy in the way that would make that would green economies, green supply chains, and all that. But all of that comes with funding. All of that comes with the sort of funding that is no longer available with the debt burden that there is. So how to free up the space, how to free up the fiscal space in order to enable some of these more innovative ways of thinking through the climate crisis is really the challenge, I think, that we're faced with. One of the things that has, I think, engaged the minds of some of us has been even questions around, borrowing in local currency, as an example of some of the innovations that we hope we might be able to get through from the public development banks and, even the institutional private capital and all that. How can we de-risk domestic local borrowing or borrowing in local currency? Because obviously we need to work through some of the challenges that have led to this particular impasse. And I think that trying to solve those problems will be important. And a few others, obviously fiscal discipline, capacity, improving capacity and all that. I think fiscal discipline is a very important feature of what we're concerned with. Transparency even around debt reporting and those sorts of things. So there are, in my view, very many specific issues that concern, African countries. And I think that thinking through a useful process.
So Professor Folds is director to the Center of Sustainable Finance at University of London. You've looked in the past and you work a lot at the interlinkage between the topic of debt distress and climate vulnerability. So can you tell us a little bit more how this is likely to be affected with the increasing number of climate shocks that His Excellency already referred to, particularly in the context of Africa, but not only tied to this context?
Yeah, thank you. So quite some time ago in 2018, we published a study for the UN on the nexus between climate vulnerability and the cost of capital, where we showed for the first time that climate vulnerability is actually driving up the cost of capital. And that's, of course, perverse because climate vulnerable developing countries have contributed little to nothing to global climate change, but they are disproportionately affected by the physical impacts, but then also they have this kind of additional climate risk premium that they have to pay in international financial markets. And back then we were arguing that we really need to emphasize much more investment in climate resilience and adaptation. And we framed this in terms of a vicious circle of climate debt and underdevelopment, where countries that don't really invest sufficiently in adaptation resilience will face this vicious circle where fiscal space will be deteriorating. They won't have enough abilities to really boost resilience. Climate change is getting worse. Financial markets are, of course, also getting ever more aware of the problem. And this is exactly what we're seeing happening now. And we've seen, of course, over the last couple of years, a large number of shocks. Now we have a couple of new shocks playing out recently on the trade front and so on. And there's a large number of countries that is massively underinvesting in climate adaptation and resilience, but of course also other critical areas of development. So UN has published a number of debt reports showing how countries are underinvesting in health, education, other critical areas. And this is all feeding into this vicious circle of climate debt and underdevelopment. And countries, governments are servicing their debt because they fear the alternatives. And the current global frameworks that we're having for dealing with sovereign debt problems is absolutely inadequate. So we have, of course, the G20 common framework. Me and others have argued for a long time that this is absolutely inadequate. I hear from various people involved in there, no, it's getting better and it's improving, but I don't really see the changes that we need to see. And I think the few countries that went in there, if anything, they've the signal was don't go there as well, because you're not going to get a speedy and fair treatment. And so countries do everything they can to service their debt, and the implications, of course, that they will cut spending on social issues and also on climate action. And this is further accelerating this vicious circle. And also for middle-income countries that are not falling under the common framework, even though I hear that this may be broadened now. I mean, no, but the situation is not better at all. And so right now we have a situation basically where countries, only countries that really can't pay anymore because they really used up all the resources will go to the IMF and call for some kind of treatment, and then they will get something. And we have 50, 60, I don't know, countries that really would need some kind of debt treatment and we don't have a proper option for them. And that's why with a couple of colleagues back in 2020, actually, when the COVID crisis broke out, we set up this debt relief for green inclusive recovery initiative where we said we need to find some ways for those countries that need debt relief to really get a speedy and fair treatment, getting away from kind of its case by case, which is really delaying this. And I know that the geopolitical situation hasn't been working in our favor, but you know, the situation down on the ground, if anything, has just gotten worse and worse. And I think, you know, the SDG agenda 2030 is basically failing. And we need to be clear about this. And so we can say, okay, that's too bad. That's what it is. You know, we can't do anything because political realities are as they are, or we try to move somehow forward with at least some kind of partial solutions, at least for low-income countries and so on, where of course then the amounts are not so large. But there are also large countries, I mean, in South Asia, for example, that really are in a very bad shape and are also in this vicious circle.
So maybe just to get into there, I mean, I think we already have now a good sense of the challenges that we are facing, but I think where it gets interesting is now the proposals that all of you are making, how to improve the situation, also with the constraints of the geopolitical tensions and everything that was mentioned before. And I would like first bring you in, Anai, because I know that the paper that was already mentioned by you brings forward an initiative that's called...
It has a new name.
Oh,
it's now called the Debt for Resilience Initiative. We're still struggling, so we take suggestions.
Okay, so this is a fast-evolving new environment, I see.
Debt for resilience.
Yeah.
Okay.
Debt for resilience, okay.
As I said, any suggestion very welcome.
So could you explain us a little bit more what this is about, and particularly to the point that Indamit mentioned before, solvency versus liquidity, because I understand that there you differ a little bit in your perspective.
Yes, absolutely. So let me just pick up on kind of a point that Uli made, which is essentially the common framework is struggling. Well, I think that's kind of common knowledge to us all, but I think that one kind of very kind of important point that he mentioned is debtors don't want to apply. There is really kind of this kind of lack of incentive. There's no clear treatment. They don't know a priori what they're going to end up with. And it's a very, very long and convoluted process. So the first thing we did in order to try to kind of propose or kind of come up with a new proposal is to actually kind of look backwards. And we looked at kind of HIPIC, we looked at Brady, we looked at the DSI, and we looked at the common framework. And we identified different kind of dimensions of these kind of debt relief initiatives, kind of to identify dimensions of design choices. And in addition to that, we kind of came up with what we call creditor and debtor requirement. So essentially kind of this is from the side of the debtor, whatever initiative one comes up with needs to meet kind of one desiderata, which is it needs to be in their net benefit. That means that treatment needs to be fairly clear and predictable, and the cost of applying annexes that cannot outweigh the benefits, essentially. From the perspective of the creditor, as I already mentioned in my earlier remarks, it's very important that it kind of at least minimally complies with a kind of sense of intra-creditor and inter-creditor fairness, and that essentially that means there is kind of no strong leakage. So our proposal then essentially kind of building on our diagnosis that we are kind of that low-income countries are facing a balance of payment problem, and that this translates into kind of a total external debt vulnerabilities, is that we kind of the objective is we want to avoid kind of an external adjustment of the type that kind of ends up in contractionary policies, and at the end of the day kind of hampers growth, precisely because of the point that Indramit just mentioned, that growth is essential per se, but also kind of to deal with debt vulnerabilities, right? So what we propose is a little bit bold, I would say, but I think that kind of difficult times call for kind of ambitious measures, is to have a kind of generous NPV reduction of net present value reduction of official debt. This is the first very contentious part of this. official debt includes multilaterals and bilaterals. We know that this is kind of one of the points where we're very open to discuss. But one of the things that this does, of course, is in a way it provides a free lunch for the 43 countries I mentioned earlier. So for the 43 countries that have kind of a large exposure, more than 90% of their exposure being in kind of PPG external official debt, that is going to provide immediate relief. Now, if that is in the carrot, this is the carrot that would make countries apply. We also require a stick in order to kind of pass what we call the creditor requirement, right? And here, our diagnosis already kind of leads us into the kind of right direction. We say it's a balance of problem. So who should sit at the center of this initiative? The IMF. We think that this needs to be an IMF-led initiative. But of course, the immediate comeback to that is going to come from anybody in the audience is, if the IMF is sitting in the kind of main chair, how can we make sure that the primary objective of your initiative, which is essentially avoid kind of painful external adjustment and debt for growth, how can we avoid that the IMF does not end up in kind of maybe a track record of the past of going for essentially kind of contractionary policies? So our proposal there very much builds on the DRDR proposal. So we've been heavily inspired by you. We also reviewed it extensively, is to have the World Bank, the United Nations, really work with country to establish country-led national growth plans. And kind of this really being the basis for the IMF program that is necessarily, for good or for bad, I think an integral part of this Debt for Resilience initiative. Maybe the last thing I'd like to mention is that this is kind of...
We mean debt relief for resilience.
Exactly, debt relief for resilience, yeah. Maybe the last thing I'd like to mention is that we think that there is a certain elegance to the proposal. And what I mean by this is that from the debtor perspective, depending on how your credit composition looks like, you will have a greater incentive to participate or not. Meaning, how do we avoid leakage? This is something that I didn't get to mention yet. If you have kind of private and non-guaranteed debt exposure, it will be a necessary condition of the IMF program for you to install capital flow management measures. If you have an exposure to the kind of private PPG debt, you will have to do a restructuring. Why so? Because otherwise the creditor requirement is not passed. There is leakage. Now, from the debtor perspective, of course, the more you need to do complementary to kind of the standardized debt treatment, which we think should be by default, by the way. So we think that all of IDA eligible countries like HIPC should be participating by default, and countries would have to opt out of this program. If countries need to adopt complementary measures like CFMs and restructurings, they're going to have less of an incentive to participate. This means that depending on how bad their status quo is, if the debt treatment of, say, kind of 50% NPV reduction of official debt and PPG debt is kind of big enough an incentive, they will apply, and they will do the things that we think they should be doing anyway. Because we think that, as Intermit rightly pointed out, the alternative would be to default on development. So to do everything they possibly can to continue paying their creditors, but not preparing for, well, not facing the urgent needs of today and not preparing for the world that is around the corner, essentially. So that's it. Okay, stop there.
UNCTAD has also brought forward some proposals how to deal with the debt crisis. And one, or the most prominent one, is the one about a multilateral sovereign debt framework that would facilitate more efficient and fair debt restructurings. And this is also being forward, particularly in the context of the FFD4 conference that we are all looking at the end of June. So what role would debt relief play in the context of this initiative? And how would this be tied to the one that Anaï just mentioned? Or what are your views on how those two go together, or maybe also not?
So thanks very much. I think perhaps to step back a bit, there's several processes that we are busy being involved with at the moment. And yes, I mean, from time to time, UNCTAD has called for a global debt authority and a sovereign debt workout mechanism. And that the two are very strongly related in the sense that there is a set of principles about looking at the environment and saying, look, this is clearly not working for borrowing countries. I mean, the one thing that I think we need to be cognizant of is, apart from the economic disincentives from getting involved in something like the common framework, there is also a whole political environment. So, you know, for a government to go into a process which can take 4 to 5 years, during which time it continues to lose credibility with its populace, is a very brave decision. And part of the problem is that it takes too long and there's no obvious benefit to the populace. And so the citizenry lose faith in the process. And I think the suggestions that we've made around a global sovereign debt roundtable, a global debt authority, is that we see this as a need to have a kind of institutional capacity that looks at these issues all the time. We shouldn't be only talking about debt when we're in crisis. There ought to be something that exists as a process that says, these are some of the innovative instruments you can use should you not be in debt crisis. These are the kinds of contracts you should be using. This is some of the experience that we've had with countries. This is an opportunity to have a knowledge base. So there's that kind of, shall we say, almost more academic side to such a global debt authority. And then, of course, there's this question of how does it really play a role in terms of engaging in a debt relief system or debt restructuring or debt reprofiling. And I think that is much more unclear. I think the part of the push that UNCTAD has made about this is really this idea that in a perfect world, these kinds of decisions could take place in a neutral territory where the overseer is not a creditor or a borrower. And so while we know for a fact that when we have seen successful debt relief programs, certain major creditors, including some of the multilaterals and some individual countries, have been at the key part of it. The question is, could some of those decisions that took place around that, could that have been done better in a more neutral environment? And I think that is the question that we are trying to pose with this Global Debt Authority. Since we've been working on that, and we have seen how, in fact, there is, in many parts of the member state body of the UN, there is certainly not, shall we say, unanimity or consensus on such an institution. What we've also been doing is supporting the SDGs expert group on debt. And one of the things that we worked for them to do is to say, if one were to think about this as a kind of a goal-oriented process to identify practical solutions, there is, of course, a lot to be said about improving the common framework, for example, but it isn't on itself the only possibility. And I think already Excellency Osinbajo has already mentioned the idea of, say, local currency. And what we did is we said, could we try and work from the goals of improving this debt morass that we currently have, according to thinking about how do you reduce the cost of debt, of new debt? How do you increase the term of that new debt? And then, because the stock really matters, you've got to do something about the cost of the stock and the term of the stock. And starting from that process, we've then identified almost, I think there are 120 measures that we've mapped. Some of them, of course, can go into many of these areas. But we have presented this now to this expert group to say, help us identify some priorities. And a lot of those issues include things like, can we at least try and make the systems that we have work better? So that would include the story around the common framework and some variation on that. But there would also be other things like increasing the voice of the borrower community. So this idea of a borrower platform where there could be at least that knowledge sharing, institutional memory role that we had identified for the Global Debt Authority. Why is that not at least in a borrower club? And this idea that coordination for borrowers can really matter. So, I mean, I think from my perspective, I think what Anahi is suggesting is very appealing. I think the concern that we tend to have is that we've also heard other suggestions where, for example, people are suggesting in the first instance, should we not just go into a new debt sustainability suspension initiative, a debt service suspension initiative 2.0, and we give everybody, you know, a moratorium for a while, and then we can figure out while they're in the moratorium, where are they in these two divides? And that also has an appeal because it allows some breather for those countries that are really in this distress.
Right, right.
Yeah, it may well be. I'm just saying that there are these different options on the ground. But I think that our view is that we've now consolidated these 120 options for the debt experts, and we finally got them into three categories. And we're saying there are some things that the multilateral system has to produce. This is not something a borrower country can do by themselves. And it's really important that we look at those. Then there are some things they need to do in coordination with others. So this could include things such as your borrowers club. And then the last set of things are the things that you can do nationally for yourself. And that has to do a lot with, you know, having an investor platform, having a national plan, having a strategy, being able to sell that to not only the credit rating agencies, but the markets and so on. What we are concerned about is that a narrative that simply looks at the one side, because the multilateral side has become so difficult, that is also going to fail us. We have to acknowledge that in this kind of morass, and I use the word morass because that's the term that S.G. Guterres announced when he said, I need an expert group on debt. He said it is a morass. And if that is your view, then you've got to look at it holistically. So I'll stop for now.
You mentioned the multilateral system, and of course, the World Bank plays an important role in the system. And Nemeth, in your previous remarks, you already identified like three key issues that you think are not working as they should, which was like debt transparency, the sustainability analysis, and fair and efficient debt restructurings. So what role do you see for the World Bank to improve these, but also beyond with the proposals that were mentioned here in the room? Like, what is your perspective? Can they provide any added benefit beyond what the World Bank is already doing?
So I think the first thing is that, you know, say, okay, what's causing the immediate risk to all of this stuff, right? Given the fact that countries already have fairly high debt levels and that they're paying fairly high debt service burdens, right? Like very high debt service burdens. So what do you do immediately? So what's in the power of these countries themselves? So I think it's essentially what is the problem right now is very high policy uncertainty, higher than any time in the past, mainly centered around trade policy, right? So our thought that UN trade would say, trade and development would say, here's the first thing you should do, okay? On trade, how do you bring down trade policy uncertainty? You can't just lecture a country and say, hey, you know, it's all the fault of the US and so on, because this trade policy uncertainty was actually fairly high even last year and so on, right? So I think that has to be the first thing. And so And so to the extent that these countries have protectionist regimes and so on, especially the large developing economy, large emerging market economies, they have to meet the US halfway or actually more. That's one thing. But the second thing is that there's this thing about, debt relief for development, right? Now, what do you mean by development? What do you mean by development? I think in the past, like for the PRSP initiative, it was, hey, if you spend this money on education and health and other things that we think are pro-poor, then these debts would actually be written off and you get a fresh start, right? And at that time, there was a general consensus in the West that development, this is education, health, and so on. These are all pro-poor things. And I mean, I guess there was also a sense that poverty was a global bad. That sense is gone. Nobody talks about poverty as a global bad. Now people say, oh, climate change is the global bad. Okay? Now, then as a result of that, basically what you get is that what is considered to be that swap is that, okay, we'll do something in your national interest if you do something that is in the interest of that is in the interest of the world. Okay. Now, so as a result of that, you end up saying things like don't do fossil fuels. Okay. That would be the climate for things swap. Okay. Don't exploit your forests because we have to keep forests. Right. Now, I think that makes the people who are the creditors or who are talking on behalf of the creditors saying, I'm going to broker a deal for you. I mean, you're brokering a deal for them. And you're saying, you know what? You're going to forgive the debt and you're going to do all these good things. Okay. You're going to, it's going to be a debt for nature swap or a debt for climate. But you're not a credible broker. Because what you're calling development, you're actually asking these countries to do things that are going to slow development. Okay, there's this very sensible guy who actually wrote this thing, and I do want to quote this to you, right? Hold on a second, I'll tell you. Who had a really good point over here. Down, I can't find it. Yes, here, right here. It says, the UK, US, and the EU have all taken aggressive steps to limit fossil fuel investments. The World Bank and other MDBs are being urged by some shareholders to do the same. Curbing natural gas investments in Africa will do little to limit carbon emissions, but much to hurt the continent's economic prospects. Natural gas doesn't make sense in every African market, but in many, it is a crucial tool for lifting people out of poverty. It is used not just for power, but for industry and fertilizer and for cleaner cooking. Now, you might say, I'm going to change my position on this, but you're not credible because we know what you really think. You want these countries to not use fossil fuels while Norway and others are continuing to use them, okay, and continuing to pump them. So you're not credible. So I would say, get the climate part out of these debt discussions. Just keep it about debt. Don't make it about things. The deal should be, look, if the creditors are going to get half of the money, then come and do this deal. Otherwise, you're not even going to get half the money because these countries are going to sink. It should be that simple. That's always the basis of every debt deal. It's never this thing. Now, if you do want to sort of say, okay, you know what? I'm going to bring in some public money into this and so on through the World Bank and others. Then don't get in the heavy machinery that we did during the PRSP HIPC initiative. There was too much heavy machinery. We were making these guys do all kinds of stuff. You have to do a PRSP paper, you have to show pro this. And then at the end, there was like a giant consulting industry that actually went and did that for them, including former World Bank people and so on. They would write these things for them. Horrible, horrible, horrible machinery, okay? And in a sense, what we are doing, we're going to end up doing the same thing. You're going to say, okay, but now we're going to have like a lot of monitoring about whether or not you're really preserving your forests, whether you're really doing this. Bad idea. Okay, so even if you do have that kind of a principle, do it with very little machinery, right? But I think it should just be a financial thing. It's complicated enough if you just do a financial thing, saying, okay, you know what? You're going to get 50 cents on the dollar if you do it now. You're going to get 25 cents on the dollar if you do it next year. Year after that, you can get zero. Okay? Yeah. So that will actually bring people to the table. But again, I'm telling you, you guys are not credible people when it comes to saying, okay, I can tell you what development really is. No, you don't. You have advocated position thing. And by the way, I think only one person would have recognized who was that person who actually wrote that. And it's a gentleman out there. I just quoted from your own article.
Okay, so that's an interesting thought. I would be curious to hear your thoughts, Oli, but also Your Excellency, because both of you have argued that we need to address the climate crisis and that the nexus debt and climate is quite important and should be part of any answer that we find. So how do you respond to the remarks by Indermit? Oli, may you want to respond?
Yeah, sure. Well, I think one problem is that a lot of people, when they hear climate action, they think about mitigation. I think, and I tried to make that clear before, I think we need to talk much more about adaptation and resilience.
That's you're saying it now, but that's not what people were saying 2 years back.
Well,
nobody was interested in adaptation. People were thinking about mitigation. That was the global public good. Adaptation, not a global public good.
Just to say that I've been, for the last couple of years, co-chairing a program called RAMP Resilient Adaptation Mainstreaming Program, where we've been building capacities at finance ministries in climate vulnerable countries.
Right.
And
I'm not talking about you personally, but
well, and actually, this whole starting point for this Debt Relief for Green Inclusive Recovery initiative was exactly this vicious circle that I was talking about. Countries that don't invest in resilience and adaptation will not develop. Yeah, and so
countries that don't develop will not invest in resilience.
Of course,
it's mainly the latter.
Well, you can invest in a lot of things, but if you don't invest in resilience adaptation, then your new roads or whatever will be washed away. So if you don't mainstream resilience adaptation in your public policies, it's bad development policy. And so the idea behind debt relief for green inclusive recovery is exactly countries need fiscal space to invest in kind of their own prosperity plans. And we've been very clear from the start, this is not about me or, God forsake, the IMF going there and telling them, okay, now you need to have a carbon tax and you need to do this and that. No, I mean, countries need to develop their own.
No, that was what the Resilience and Sustainability Trust was, that they were going to go and tell them that this is what you should do. And then they realized, oh, shoot, we don't have the capacity. Yeah, but the World Bank does. So the World Bank is going to tell them on our behalf. That's what it was. Ulrich, you can sugarcoat it or whatever. Or maybe your plan was something different.
Yeah,
but the way but the way it ended up getting implemented around here, or starting to get implemented around here, was not that. It was basically PRSP 2.0 for these countries saying, we're going to give you access to this trust if you do XYZ things. Okay, and those XYZ things, you're saying, oh, I think that just by the way, adaptation was an afterthought, but it was an afterthought and a half-baked one. Because if you really want these countries to become more resilient, what is it that makes France more resilient than Nigeria to climate change? Is it the fact that France has roads that will withstand a 100-year flood and Nigeria doesn't? No, it is because France is more developed. It has more insurance markets. It has people who are educated, who can move around, who can take actions. It has many more weather stations. I think France has more weather stations than all of sub-Saharan Africa combined, okay, in terms of long-term information and so on. And then you can come to this other part about infrastructure, et cetera, et cetera. So it was not very well thought out. I'm sorry. Okay?
Yeah, but you're talking about the IMF's policies now.
And by the way, mostly Okay, I can actually quote you. I can. I have all this stuff down.
So maybe in the interest of time,
Just like
to give the word to Professor Osunbacho, and then allow for some questions that the audience surely has with this heated debate right now.
I've already said what he was going to say. I quoted from him. Yeah, continue.
You have to keep quiet.
Okay.
Give him a chance.
Your own quotation.
Agree with that article that he cited. But I think, just to say that, that it's important for, and which is one of the points I will try to make in the ALTRI, the African Leaders Debt Relief Initiative, is that there's a need to think about this differently, and one of the critical issues is really the point around even the way the global financial architecture will always incapacitate developing countries, and especially fragile economies. It's almost going to be always the case unless we do something about that. So the cost of capital, borrowing, how do you even react to some of the, to some of the geopolitical crisis, trade, and all of those things? It's evident that unless we think about this differently, and it's not just a matter of looking at a few ideas around how do we solve the current debt crisis. It more is a mindset, So when Europe ran into trouble after the World War, there really wasn't too much hair splitting. The Marshall Plan came into operation. There was very much hair splitting. And I think it's the sort of thing that we ought to be thinking about. How do we do something that is massive, that's big, that addresses these concerns on a permanent basis, So the sort of give and take, to Ndemith's point, give and take, do this so that we can do that. It's just going to get us back into this cycle and another, assuming we were to solve this problem now. We'll be back here in another 20 years or maybe even faster. So I think there's a need for a different way of looking at this. And it has to be fundamental. It can't just be, a piecemeal sort of approach.
Ulrich said, he actually laid out the problem very well. He said, this is the thing that happened. The reality on the ground continued to deteriorate, and the things change around us. The global debate changed around us. So the next step shouldn't be, let's double down on that approach. The next step should be, let's reflect on this. Let's reflect on whether or not, so for example, two complete inconsistencies, okay? I would see this again and again. And I've written this down, by the way, okay? Except that I'm not allowed to publish it, though Yemi does. Maybe I should supply him all of this stuff. Okay, so you read the thing like this. Climate change is a major risk that exacerbates the country's vulnerabilities. So you see, this is good. He's going to now say, make this country more resilient. No, it's emphasizing the need to transition to a low carbon development. Where did low carbon come from? It should be more resilient. Okay, but that's one. Then the other thing is, you have these two smart people, N.K. Singh and Larry Summers. They write a report, okay? And the report is summarized. I can give you the broad thing, okay? The world needs an additional 3 trillion every year to finance development and climate action. All right, good. Number 2, the developing world must raise 2 trillion of this. So 2/3 of this must be raised by the developing. The international community will come up with 1 trillion, okay? Half of it will come from the MDBs and bilateral aid agency, and the other half from the private sector. So, good luck, yeah? Okay. But wait, it's not done yet. 2/3 of the additional 3 trillion, okay, which is 2 trillion, would be spent on climate change and 1/3 on development. So you raise 2 trillion, okay? And so you raise 2 trillion, you're a developing country, you raise 2 trillion. I'll add to it 0.5 trillion, I guess. But you're going to spend 2 trillion on my priorities, not on yours. Even though you're poor, it doesn't matter whether you're poor or not. You want to spend it on my priority. This is the MDB's report, okay? You tell me, these two smart guys, okay? Obviously, they were in some kind of a time warp, okay? Let's get out of the time warp first and say, Is this the way you want to think? No, this is not the way you want to. You want to think the way Yemi was writing. Yeah.
So I invite the room for reflections. So yeah, gentleman in the back.
Hi, I'm Rick Browden. I've been working with Office for OHCHR for the last several months analyzing the IMF's DSAs. And I think we actually quote you in your piece because we're also concerned about the IMF is not always calling a spade a spade. They're not always saying restructuring is needed. And I just want to know, what are your thoughts about that? Do you think the IMF is ever going to be redeemable and get beyond this problem they have, and that countries should just start doing their own DSAs or look to other institutions for doing DSAs? I'm just curious your thoughts on that. And Penelope, I know you guys are going to have this very creative thing about sustainable, I don't have the written name right, but the sustainable development,
yeah.
The framework. And you guys have just come out with the Mark II, the new edition. If you could explain to us about that, that would also be great. Thanks.
I would take maybe one or two more questions. Bodo and Jan.
Yeah, Bodo Amos from Global Policy Forum. Thanks for your proposals. It was a nice new one, and I hear on the debt broker procedure. Similar to Rick, I have a bit concerns about the role of the IMF and if there's an institutional host. So I was wondering, couldn't we just merge these two proposals and take the Global Debt Authority as an institutional host, or can we get the two things together?
Yeah, hi, I'm Jana from ISD. Thanks for all the panels. It's a very fascinating discussion. My question is, so given that last months, but particularly the month of April, with the tariffs have been, I would say, financially and economically a bad thing. You know, yesterday I heard the phrase that in R minus G terms, R goes up and G goes down. But on the other hand, I would be interested to hear your opinions on if this can also be an opportunity for multilateralism, and if so, in what terms?
I would take two more questions and then we go back to you. So,
hello, Bruna from UNCTAD. Thank you so much for your reflections. Just interested because a lot of the discussion, of course, naturally is on debt, but debt is not a means to an end. So what happens once we solve the debt problem? How do we reignite growth, or essentially what practical solutions exist right now to address the growth, the slow growth era that we are entering? Can the MDBs do something about it? Like there is the proposal on the capital adequacy framework. How can it be implemented now that we're no longer talking about billions to trillions? That idea is dead in the water, unfortunately. But there's so much talk about guarantees and spurring private sector investment, catalyzing private sector investment through the MDB. So practically, how can this be done?
And then last, Michael.
Thank you very much, Sarah. Michael Jacobs from ODI Global, and in this conversation, advisor to the expert review on debt, nature, and climate, which just published its final report. I hope everybody knows that, being launched tomorrow. I wanted to just to clarify what the triple agenda of N.K. Singh and Larry Summers was. I think they would argue that this wasn't 2/3 climate and 1/3 development. They would say 2/3 climate and nature-related investments and 1/3 other development investments, and the climate and nature stuff is pro-development. Now, your point that there's been a lot of focus on mitigation in the stuff that comes to the north, I think is absolutely fair. I think it's also absolutely fair that Ulrich and others, and Moritz Kramer, and indeed the expert review, are focused on resilience as climate action, for the reason that, exactly as you say, mitigation expenditure may or may not be pro-development and a reduction in risk. It can be. Fossil fuel prices are volatile, so if you go for renewables which are cheaper and less volatile, that actually may be reducing your risk. But resilience investment reduces risk. It improves your growth prospects, and therefore much more closely tied to the debt problem. And that the expert review's focus is very much on resilience. So I think that's kind of clarification on that is useful. I wanted to raise two things. So one is Martin Guzman, who is with Joseph Stiglitz, is running the Vatican's Debt Jubilee Commission, which is the every 25 years, the Catholic Church has a jubilee, which is a debt forgiveness principle, and so there's a commission. His point, and he's the former finance minister of Argentina, which has more experience of debt defaults than anybody else, done it twice, and on very, very big scale. He says the problem is right now, the multilaterals, the bank, the IMF, are bailing out the private bondholders. Yeah. So what's happening at the moment is countries, they've got net debt flows which are negative. They're in liquidity problems. So the IMF has come in with to some extent, the bank with emergency funding. But that emergency funding is just going straight out again to pay the private bondholders, because that's the overwhelming part. They are first claim on resources. And until you get rid of that, you don't really get an incentive to restructure the debts. And his experience from Argentina is countries need to go into default. There needs to be no more bailouts for the private sector. Countries need to go into default and then restructure out of it. And he would say default looks terrible, but private creditors look forward, not back. And a default gives you a much better position. It puts you in a much stronger position. So when you next go out to the market, you look much better. And the fact that you've defaulted is much less right. Now, countries are afraid of default. I mean, that's why they're not going into the common framework. They hate the IMF programs and so on. So I just, and your experience would be the same, Your Excellency, just kind of, are the multilateral institutions actually not helping right now? Because they are effectively transferring money out. And then just to kind of...
Michael, I have to...
Okay, that's going to be my one thing. I'll got other things. Very good.
So a lot of food for thought. We have 5 minutes, so each of one got 1 minute to respond to all of this.
I didn't realize we had so little.
I'll make 3 remarks and try to be very quick. So I think the first response is, I think kind of our proposal is not a first best world proposal. It's not a second best world proposal. It's probably not even a third world best proposal. So we tried to be extremely pragmatic, learn kind of in the realm of what is difficult, but somehow feasible. The reason why, and I completely agree, and I wanted to stress this with the point made by His Excellency, that we kind of face a global international financial and debt architecture, which is highly asymmetrical and which works very much kind of in disfavor of developing countries. In an ideal world, I would very much like to write a proposal that addresses that. But I think that we need to balance, on the one hand, the urgency of immediate relief with kind of the long-term continued effort to reform the international financial architecture. So to Bodo's point, I think that the reason why we think that the IMF needs to be involved is A, because of our diagnosis, but B, also because we think that a bargain needs to be struck between kind of what we call the debtor requirement and the creditor requirement. And though we think that it is absolutely vital to, in a way, tie the IMF's hands in order to not kind of go down the route of austerity policies to kind of resolve external adjustment, we think it needs to be involved. On DSAs, I just wanted to say, I didn't kind of completely answer your question. One thing that sets our proposal apart as well is that we don't rely on 2 treatment groups. So the DRGR, but also the BRICS proposal, which Martin Guzman, but also Jacques Diwan, Martin Kessler are kind of Vera somewhere key authors from. They both divide kind of into 2 treatment groups in a way. One that kind of is facing liquidity problems and hence needs a liquidity solution, and others that need to go to the common framework essentially. What we're saying is it's very, very hard to do that judgment call, and we have experience in that. So what we're proposing is standardized treatment for all IDA eligible countries, and then kind of targeted complementary measures to avoid leakage. And lastly, on the multilaterals, I agree. I agree with the fact that countries need to restructure. I agree with the fact that kind of default is often the more painful solution in the short term, also politically not kind of the most appealing thing, but that it sets you up for a better debt and macroeconomic trajectory. But I just wanted to do the caveat that in the proposal we're making, what we're saying is we don't want leakage, right? So we're kind of proposing both things in parallel. We say, if you want to kind of get, say, 50% of a net present value reduction in official debt, you first, if you have private sector exposure, you need to do a debt restructuring with bondholders. And if you have private non-guaranteed debt, you need to install CFMs. So the idea is to have kind of a package solution in a way.
No, you go. I'll go on too long.
So thank you very much. With regard to the DSAs, Rick, I would say that it's actually really important that countries can do their own DSA. So I would be all for that because they need to be able to engage properly with the IMF around their data and understand why there are differences. So although it is a tool that is not infallible, we know that, it's something that countries need to be familiar with. UNCTAD has a sustainable development financial assessment. It's a framework that really starts from the demand side and says, what are the constraints on growth? And for most small open economies, that's the external constraint, the balance of payments. And then we use that to try and understand where can growth come from and what policy options do governments have. We've incorporated the first 4 SDGs. What would it take for you to be able to meet your debt servicing plus do the SDGs? And then we added some of their nationally determined commitments, because that would be the climate story. The issue, of course, is that what it does do is it simply provides a way of thinking for policymakers to start to see the constraints and understand where they may be able to do some maneuvering. I mean, I think the thing that has come up again and again, and I think His Excellency raised this very well, is this issue of it's not only about who is setting the agenda, because that's crucial, but it's also about where does the incidence of risk fall. And the concern is that for many developing countries, they carry the risk. And to Intermit's point about the trade issue, one of the concerns that we have is that if we now live in a world where everybody has to make a private bilateral deal in order to continue to trade, then we are pushing the risk of a non-functioning multilateral trade system right back onto the small countries, especially the small countries, because they have no bargaining power. They can sell their family jewels, but still it won't work. And so our issue is that we need to find a way. We were never particularly excited about how well the multilateral trade system was working, because for obvious reasons, it's dysfunctional. But the question is, maybe that is this opportunity that we can think about, is to say, well, this has clearly brought things to a halt. What would it take to actually make a system that works so that some of these risks are not pushed directly back onto smaller countries?
Why don't you take my minute as well?
Well, I wanted to respond to Michael's question, are the Bretton Woods institutions part of the problem? And I would say yes. I mean, the DSAs are deeply flawed, and I mean, that's been also center point of our DRGR proposal. We really need to include critical spending needs for SDGs and so on. I think exactly a year ago at the spring meetings last year, we published a report called Defaulting on Development and Climate, where we did our own DSA, where we kind of looked how would the outcomes be if critical SDG spending needs are included, and the outcomes are of course much worse. And there's also a political reason why the IMF doesn't do this kind of analysis, because
that's not the point of the DS. Anyway,
well, but so the question is really, are the DSAs fit for the job? And I would say no. And
I would agree with you, but not for the reason you mentioned.
That's good. But the IMF still characterizing this situation as a liquidity problem. I think this is deeply misleading. I think Intermit is one of the few voices in DC that has publicly spoken against this, which is great. But effectively, we are seeing this private creditor bailout. I mean, that's something I've also been trying to highlight for many years. I mean, take Kenya, kind of IMF gives an RSF. And even though, they prescribe all kinds of things, I mean, the open secret is that the RSF money has been used to pay back Eurobond holders. I mean,
absolutely right.
That's where the money goes. And so this is a massive bailout of private bondholders, and that's not what we should be using MDB resources for.
Not in 43 countries, though. That's not in 43 countries.
No, not in 43 countries. Yeah. But of course, there are some countries that are basically dependent on public development finance, and that's why we've been also arguing that we do need MDBs to be involved in debt restructuring. And Intimate was at an event where we discussed our report at the Marrakesh annual meetings, and I think that was politically not correct of you to say, but you were basically agreeing with that, I think. Can we stop the live stream for a second?
Why? No.
But yeah, so I think we really need a reset, and just to make one final point, I do agree with you, Intimate, that whatever countries do after debt relief, I mean, that should be country driven, and you haven't come up with any quote, and you won't find any quote where we have been saying kind of we want to dictate.
No, it wasn't that. Ulrich, everybody keeps talking about mitigation versus adaptation and so on. I just looked at the numbers. Okay, this is what the numbers look like. It's 90% of global climate finance went to mitigation.
Of course,
you talk all you want about adaptation, but at the end, you have to follow the money.
Yeah, because nobody listens to me. That's the problem.
Okay. Nobody listens to me.
So I think discussion to be continued.
One quick thing on the DSA. So so it's not like the fund cannot do a DSA. They can.
Of course they can.
If you look at the DSA for Japan, it would be a good DSA. The trouble is that they use the same framework for Sri Lanka. But Sri Lanka doesn't borrow only its own currency. Suddenly now it becomes a weak one. Okay. Now, then you go to the low-income country DSA. The low-income country DSA is a dinosaur. It's from a time when these countries only got money from official creditors. So you have that whole apparatus thing. And by the way, over time, basically they have made adjustments to that. We have made adjustments because it's the World Bank, IMF, DSA. But the adjustments have made that thing impossible to understand from anybody. So I would not say, it's of course a country should be able to do a DSA by itself. But it doesn't mean that the IMF and the World Bank shouldn't do a DSA for the same reason that Japan has the capacity to actually do a DSA. But the fund does it anyway because of surveillance, right? I think you need to do that, but you need to make it fit for the purpose at hand. The purpose at hand is very different. It's impossible to understand because it's just been loaded up with all of this other stuff, okay? So what I say, gut that thing and do something that is actually realistic for these countries that people in the country can understand. And they can explain. It will happen.
But I think that's what everyone would agree on.
It will happen, but you guys keep making this point and so on. I'm doing it too, but just make the point and make it fearlessly. Don't stop any live stream. Speak loudly.
Thank you so much. Great panel. Thank you.
It was a pleasure. Yes.